Our investment philosophy is quite simple. Everything we do is to try to figure out how best to increase the returns without increasing the risk in the portfolio. Efficient frontier studies have allowed us to reduce risk in portfolios and try to maximize return. As we know, there's no such thing as no risk. Short term, you're more secure in bonds. Longer term, you're more secure in stocks. So the most important issue when you're investing your money is the stock-bond mix. Most people are terrible at figuring out the right mix. In 1990, Harry Markowitz was awarded the Nobel Prize in Economics for the work that he did talking about asset allocation. We were one of the first firms in the United States the year after to fully embrace the work that Professor Markowitz had talked about. And simply explained, asset allocation is building balanced portfolios and practicing humility. No one predicted 9/11, no one predicted the Persian Gulf crisis, no one predicted the crash in '87, and what we're discussing here are three of the six biggest downturns in the last 30 years in the financial market. What the pros have figured out over the years is that the essence of efficient frontiers is to build a portfolio so that no matter what happens, you look reasonably smart. A portfolio that has 100% in bonds, it is the lowest return portfolio, but it's not the lowest risk portfolio. By introducing a sliver of 20% of stocks into the account, you actually get a reduction in your risk and an increase in your return. What they figured out is that your risk line keeps going up, but your return line tends to flatten out once you get past 50% of stocks. Most people aren't any good at adopting a discipline to keep that balance intact. Investing is ultimately a lot of hard work. It requires an enormous amount of discipline. It requires an enormous amount of attention to a particular methodology. The essence of our work is to get the mix right. At many investment firms, they make way more money selling stocks and stock funds than they make selling bonds and bond funds. And the average brokerage firm has, in my opinion, a much more aggressive portfolio allocation than what is accepted at the better investment boutiques as well as in the academic community. The last 25 years, 40% of stocks had returned 11.2%. 80% of stocks would have returned 11.8%. For that puny 0.6% difference, you had almost 4 times the risk. So the novices will say, well, Bob, 0.6 is a bigger number. Yeah, that's right. But the pros will say, well, what do you want to put up all that risk for? So we found over time that tortoise really does win the race, that hare will bust out of the starting blocks, but that old turtle will ultimately win.